Hello everyone, I'm Miles. Today we're going to use the complete three-step accounting cycle to learn by doing. What is the accounting cycle? It's the process that takes you from original transactions to clear financial statements. Why is it important? Because without it, you can't truly understand a company's profits, cash flow, or financial health. Case study. In January 2025, ABC Incorporated issues stock for $60,000 cash, takes a $70,000 loan, buys a truck for $120,000, 60-month useful life, no residual value, and prepays $6,000 for 6 months' rent. They earn $45,000 revenue, $15,000 cash, $30,000 accounts receivable, $50,000 unearned revenue for February services. They pay $12,000 wages, 20% tax rate, January 31st. These are the economic activities startup companies' first month. The first step of the accounting cycle: analyze transactions, that is, make journal entries and post them to T accounts. Let's start writing the journal entries. Debit cash $60,000, credit common stock $60,000, debit cash $70,000, credit notes payable $70,000, debit fixed assets, truck $120,000, credit cash $120,000, debit prepaid rent $6,000, credit cash $6,000, debit cash $15,000, debit accounts receivable $30,000, credit revenue $45,000, debit cash $50,000, credit unearned revenue $50,000, debit wage expense $12,000, credit cash $12,000, debit income tax expense $6,000, credit cash $6,000. Accounting begins with precise and meticulous record keeping. Here, 8 transactions are each recorded in their respective T accounts. Asset accounts, cash, accounts receivable, prepaid expenses, fixed assets, liability accounts, notes payable, unearned revenue, as well as revenue and various expenses. Posting is like putting together a puzzle. Every piece has its place. Remember the rule of balance. Increases in assets and expenses are recorded on the debit side, while increases in liabilities, equity, and revenue are recorded on the credit side. This is the basic grammar of the accounting language. Step 2. Adjusting entries and preparing the adjusted trial balance. In the first step, we only recorded the transactions, but that doesn't reflect the passage of time. That's why the second step must include adjusting entries. Why is that? Because the timing of cash flows often doesn't match up with when revenue is recognized or expenses are incurred. For example, prepaid rent, insurance, and utility bills need to be gradually expensed over the months as they're used up. Fixed assets that you purchase need to be depreciated, spreading the cost over different accounting periods. Unearned revenue you receive in advance is recognized as earned revenue as service is provided. And accrued expenses like wages payable also need to be recognized in the current month. Only by doing this can the financial statements reflect the true economic situation, not just the movement of cash. So, under the accrual basis, we need to make end-of-period adjustments for ABC Company. For depreciation, debit depreciation expense $2,000, credit accumulated depreciation $2,000. For rent, debit rent expense $1,000, credit prepaid rent $1,000. Only in this way can we reflect the portion that was actually consumed in January. Next, we prepare the adjusted trial balance, which serves as a cornerstone, summarizing all amounts after regular transactions and adjusting entries, providing complete and accurate data for the income statement and balance sheet. Cash $51,000, accounts receivable $30,000, prepaid rent $5,000, fixed assets $120,000, accumulated depreciation $2,000, net $118,000, notes payable $70,000, unearned revenue $50,000, revenue $45,000, common stock $60,000. Now let's move on to the checkpoint. The ending balances must ensure that the total debits equal the total credits. Otherwise, the financial statements simply cannot be established. For ABC Inc., debit and credit sides $227,000, perfectly balanced. Step 3. Prepare financial statements, close books. Based on adjusted ledger, income statement. Revenue $45,000 minus expenses $21,000. Net profit $24,000. Retained earnings statement. Beginning balance 0 plus current net profit $24,000. Ending balance $24,000. Balance sheet. Assets $204,000 equal liabilities $120,000 plus equity. $60,000 common stock plus $24,000 retained earnings. Cash flow statement. Ending cash balance $51,000. In addition to the income statement and balance sheet, we can also derive the cash flow statement directly from cash-related transactions, distinguishing among operating, investing, and financing activities. This is exactly the process that analysts, bankers, and fund managers rely on for decision-making. Finally, we close out revenues and expenses to retained earnings, so that in February, we can start from 0 without carrying over previous revenues and expenses. Only the balance sheet is a permanent account, so its balances are carried forward into the new period, while the income statement is a temporary account and resets to zero at the beginning of each new month. To sum up, the accounting cycle shows us that finance is not just about recording cash. It's a process of slicing time and revealing the flow of value. By mastering these three main steps, you can go from a single voucher to a complete set of financial statements. Every entry and every closing is a window into the financial workings of a business.